To our chart of the day, it's Target shares higher despite lowering their full-year guidance. There's the stock by 3% to the upside. Our Stephanie Link owns it, joins us now. So the beat is overshadowing. It's good to see you, Steph. Thank you for being here. The beat overshadowing the revenue miss and the guidance. Do we characterize this as good? Was it a good quarter? How do you assess it?
I think it was a mixed quarter, Scott, where they beat on earnings, they missed on revenues. Comps down 5.4% was about what I was thinking that they would do. The guidance is midpoint of the range, about 750, kind of where I thought that where it would settle out. I think the clear positive is the profitability in the quarter. Operating margins were 4.8% versus 1.2% last year, and gross margins were 27% versus 21.5% last year. So they're making a lot of progress, and inventories fell 17%, and inventories in discretionary fell 25%. All of this, if you wrap it up, is that they're doing better in terms of price increases, less markdowns, and also better than expected freight costs. So I think all in all, it was a mixed quarter, but I think that there's a line of sight that this company can do something like $11 to $13 in earnings power by 2025. And I think if you look at it on a longer term basis, it's pretty attractive at 11 times that number. The stock is down 26% from its highs, very low expectations. So I think this is the beginning of the recovery. You paint a scenario, though, in which even you sound as though that this stock's going to be in the penalty box for a while. I mean, you start throwing out 25. I'm thinking, well, you know, a stock that's $50 plus off of its 52-week high is going to take a long time to get back to that level. I think it will, but I think that there's definitely a line of sight, right? That they can do $8 to $9 in fiscal 24, that's next year, and then maybe 11 to 13. I think the real important point, though, is its inventories have really plagued this company, and they're now getting it under control. And again, they're doing much better on the profitability side of things, and I really care about that because once we do get demand to come back, revenues top line, then you are going to get that positive operating leverage. And so I think the stock is really attractive. It's 17 times earnings, but that's trough earnings, right? That's on this year's earnings. So I don't think that's all that commanding as well. You get a 3.6% dividend yield, and it's just a high-quality company that's down and out, and I think there's some upside, going forward. All right, Steph, I appreciate it. Thank you. Thank you. That's Stephanie Link back at our headquarters for us. You looking at this, Carrie, at all?
You know, it's interesting, Scott. I looked at it 2 days ago, and I went through all of the numbers, and I went back several years. So if you go back to 2019, in fact, where the earnings were not too far from what they are going to be this year. And also, if you look at 2022, last year, the expectations was that we'd be earning $14 if you look at the next fiscal year. So the reason the target's in the penalty box is they're disappointing investors. Every single time the stock takes a leg down, people buy it. Stephanie's brave to have done it, and I think that it will work out eventually. But people are underwater. I mean, eventually is a loaded word for an investor. There are people who are getting tired. They bought it down 20%, 30%, 40%. It's down more than 50%. And the online business off 10.5%. Not so great. And, used to have a love fest with Target. It had a higher multiple than Walmart, and that switched again. So I think they've got to show another quarter or two before people are really going to believe that it's a recovery story. Then there's TJX, Joe, up near 5%, new record high. Yeah. On earnings, revs beat. Same-store sales up 6%. That was double the estimate. You own it in the T. Remarkable. And in 2024, they now expect same-store sales to be up 3 to 4%. Previously, is guided to 2 to 3%. Strong traffic trends. Let's understand, this is a consumer discretionary stock. What Target is, what Costco is, what Walmart, they are all consumer staple stocks. And one of the problems for consumer staple stocks is that the dividend yield, 80% of the overall sector, has now fallen far significantly below the 10-year Treasury. Keep in mind, it used to run 50 basis points above a 10-year Treasury. So there's obviously something inherent to the business at Target relative to Costco and Walmart. And I'll say this, Scott. It's apparel. I have done a
awful job in trading Walmart individually, right? My own intuition, I have traded Walmart awful. They're going to report
Thursday.
They've got the
Tomorrow before the bell.
Then they've got the grocery business, which it should insulate them from some of the challenges maybe that Target has experienced. But Walmart's gone basically straight up, right?